Let's talk about AMT. Okay, so I'm not even going to begin to try to explain to you what AMT is or why it was created. But the simplest thing I will say today is that it rears its ugly head when you have a high total income and a low taxable income. So I'll go over an example to show you what the consequences are of using your capital gains exemption when you sell some farmland, because you will have to pay some taxes. So here's our scenario. Let's say you sold your farmland for 2.1 million and you had purchased it for $1 million. So you have a $2 million gain, and you have a $2 million capital gains exemption because both you and your spouse have $1 million each. So you would think that in this scenario, I have a gain of 2 million, I have a capital gains exemption of 2 million. There shouldn't be any taxes, right? Well, not necessarily. There will be some AMT. Let me show you what I'm talking about here. Okay, so here we have husband and wife. We have a capital gain of $500,000 each. So why $500,000? Remember what I said earlier? 50% of the gain is taxable, 50% is tax-free. Both mom and dad have $1 million gain each for a total of 2 million. Only 50% of their individual gains are taxable, so it's only 500,000 that's taxable in both of their hands. So here we can see total income of $500,000 each. Okay. And if we keep going down here, we see that the capital gains deduction happens at this level here. So now when we look at taxable income, we say perfect, 0. So in this scenario, mom and dad have 0 in taxable income. So you'd think, perfect, I don't have to pay any taxes. Not the case. When this happens, you have a high total income and a low taxable income, AMT happens. So AMT gets calculated. In this scenario, dad would have to pay $37,000 federal, $18,000 in provincial, $37,000, and then mom would have to pay $37,000 in federal and $18,000 in provincial taxes. So for a total of $55,000 each, for a grand total of $111,000 in taxes owing. So if you sell your farmland and you use your capital gains exemption, I can almost guarantee you're going to have to pay some AMT. But this isn't all bad news, okay? AMT is basically a prepayment of taxes. So you would pay this $111,000 in year 1, but then in year 2, now that the farm is sold, if you have a taxable income in that second year, so let's use an example. Let's say you have $11,000 in taxes owing in year 2. You don't have to make that payment because you have an $111,000 AMT balance. $11,000 comes off the top. So now you're left with a $100,000 AMT balance. So over the next 7 years, as long as you're generating some taxable income and you have to pay taxes, you don't have to pay any of them as long as you have an AMT balance. Okay, so you can recoup those taxes over the next 7 years. A couple of things to watch out for. If you pass away within the next 7 years and you still have an AMT balance, you're not able to recoup those taxes. Those taxes are gone forever. So don't be selling some farmland if you're 99 years old and on your deathbed. You will have to pay AMT, and if you die the following year, you'll never have recouped those taxes. Secondly, you have to make sure that you're generating enough taxable income every year so that you have some taxes owing. So for example, don't blow through all your RSPs, sell your farmland, and all you have left is CBP and OAS that's taxable, and that's only generating a taxable of about $4,000 a year. You're never going to be able to recoup that $111,000 in taxes that you paid when you sold your farmland. So you have to make projections here, and you have to make a game plan from a tax perspective. When are you going to trigger AMT, and how are you going to recover it by triggering some taxable income?